Hey, what's up everybody? Wanted to do a quick video on understanding how liquidity works in the markets. I think it's a concept that doesn't really get talked about a lot, and ultimately it comes down to one of the fundamental components that we see on the charts every single day. The market relies on liquidity in order to move, and if liquidity doesn't exist, it will be created or manufactured. So it's something to always keep in mind when you're looking at particular aspects on the chart. If we look at, we use pound US dollar as an example, what we'd be looking for is essentially equal lows and equal highs. And basically what these represent is when we are trading retail-based strategies or strategies that any new trader learns when they first start out, usually it surrounds support and resistance, and double bottoms and double tops. I know personally that's how I first learned how to trade, and I'm sure many of you also learned to trade that way, where if you get some sort of support zone, you would be waiting for price to return back in, reject, and then look for some kind of entry, whether it would be just right at that prior low or some type of retest or break of the highs. But essentially the point remains true that you would be buying on double bottoms and selling on double tops. Now, when we're looking at the Forex markets or trading in general, we're up against the smartest people potentially in the world that have access to the largest pools of money. And we understand that when money is involved, many people get greedy, and more is always the objective, and there's never enough, or at least that's the way it seems when we're looking at any sort of hedge fund, bank, institution, things like that. So it's only natural that there'll be a lot of misinformation out there in the world in terms of looking at charts. Why do you think that there are so many brokerages that book clients, but also provide education using indicators, doing case studies on support and resistance, double bottoms, double tops, then also offering deposit bonuses, say you deposit $100 and get free $50, things like that. They're trying to entice people to get into the markets. Why? Because they want to generate liquidity. If we're looking at a B-book broker, which means they take the opposite end of your trade. So if you're selling, they're going to be the ones taking the buy orders. Your orders don't actually hit the market at all. Whereas there are other incentives of just ultimately getting more traders into the markets and generating liquidity. So when we're looking at that sort of construct, we can understand that this game is very much rigged. It's heavily manipulated, and that's ultimately why patterns don't work. They work sometimes, and the reason why a pattern or support and resistance do work is when you're looking left on a chart, you'll see that, and in hindsight it goes, okay, this all makes sense. You know, I seen this push down, I seen this bear flag, I seen this larger ascending channel. Great, that looks fantastic when I know the outcome of the trade. But it's actually coming to that conclusion when it happens. That's not ultimately the easiest way of doing things, and ultimately that's where the manipulation begins. They're going to show these patterns play out occasionally so that retail traders buy into the fact that they work. And don't get me wrong, they do work if you apply them correctly, but at the end of the day, a lot of these patterns are heavily manipulated. So if we get back to the concept of equal highs and equal lows, what we can see is price is moving to the upside. There is no real question about that. We see this large impulsive move to the upside followed by another impulsive move to the upside. Then we see price consolidating. We've created equal lows. So a lot of retail traders would be looking for buy entries. They'd be buying up here with a stop loss just below. They may have bought just down here because if we look even within that range, we have equal lows. So putting buy orders with maybe a stop loss just below and targeting to flip their $100 account into $1 million in a week or less. But when we see this, a lot of people get excited and they think, oh, this trade's running really great. We can see that price has pushed away if they took entries here. You know, they're wanting to back up their Brinks truck because soon they're going to be able to fly a private jet to an island and live the Forex lifestyle. What is liquidity going to do? We're going to seek all of the liquidity that rests underneath these lows before we continue to the upside. There's no doubt that we were moving to the upside, but we needed to tap into all of this liquidity in order to actually fuel the move to the upside. Now you hear from a lot of people that there are such things as stop hunts, and you hear it time and time again, oh, my trade was right, but my broker did a stop hunt, or institutions did a stop hunt. Well, that might be true in some aspects. In a lot of cases, that's simply not the case. A stop hunt is really just a target of sell or buy side liquidity. So in this case, this is sell side liquidity, this is buy side liquidity. And what is happening here is we have a bunch of orders sitting under here. There is a ton of money sitting underneath these lows, these equal lows. Why? Because retail traders are taught to buy at support, buy at double bottoms, and put your stop loss just below it. So if we understand that logic, if we know that that is the way we've learned, and we know that that's what you find on Baby Pips and so many other courses that we see online, why do we think that institutions don't know this? Of course they know this. They're the ones that created that misinformation in the first place. So what are they going to do? They're going to wait, target those areas of liquidity. That's going to fund their move. So anyone who bought here, their stop loss sits here. And in order to take a buy, someone has to sell. And in order for someone to sell, they need to take a buy. So when someone gets stopped out of the market, they have sell stop orders sitting in this particular area. So that means once price hits their stop loss, they execute a sell order, which executes on the other end. Someone's buying. Who's buying? The institutions are buying. The people who are targeting the actual liquidity. Now, if we want to look at it in a couple different ways, we can view they as people, actual people that are sitting at trading desks for large institutions and trying to play the liquidity. But in most cases, especially in the age that we live in, what we are really up against is algorithms. They understand. They've been programmed by people. They understand this concept that we need to target sell side liquidity to look for a further push up. We need to fuel this move to move to the upside. When we're planning a trip, any type of road trip, the first thing we need to do is understand where we're going to stop to get snacks, where we might stop to get gas before we actually begin to move to our destination. It's very unlikely that we're going to drive 500 kilometers without stopping for gas, stopping for a bathroom break, what have you. It's the same thing with the markets. We need to plan our trades to understand, okay, where are we going? Where are we likely going to stop to get gas or liquidity? And once we get that liquidity, we're going to continue to our destination. And what we can see with this particular trade move is we've tapped in, we've broken that liquidity, it's fueled this move, which is now pushing the market higher. So when we're looking at this overall trade situation, we know that price has now tapped into the sell side liquidity. We have the fuel we need to continue to the upside. Now, the markets, like I said, were heavily manipulated. If we just look at this overall range, what do we see on the top end? We can see that we have equal highs. We have a high here, we have a high here, we have a high here, we have a high here. We even have equal highs here. And just like I said about the equal lows, we have retail traders who see this as a resistance zone, see this as a resistance zone, see this as a double top, a triple top, quadruple top, a double top, triple top, quadruple top. Here, they're stacking in sellers. Where does conventional knowledge tell us to put our stop losses? Just above prior highs. That's what people are taught. That's what we've been told time and time again to put our stop losses. So it's only natural that we've taken out sell side liquidity. What's the next target if we're going to be going to the upside? We're going to target buy side liquidity, because anyone who has sold in these areas have their stop losses here. And in order for people who are selling to get stopped out of their trade, they need to buy back their position. So again, that fuels this. And this is how we can approach all bits of price action. We can see that once we break the market down into this overall construct, we can understand why price does what it's doing. We can see we had these equal lows. We spiked the low here. People are still buying, but we broke the larger lows because this probably didn't shake out quite enough liquidity, because people had their stop losses a little bit deeper because they weren't playing off of these lows. They were playing off of these lows here. So if I play price forward, we can see that price will eventually break to the upside. We've now cleared out all of this buy side liquidity, and we've basically created a break of structure. And if we just keep playing price forward, what we can see now is price is now creating a set of equal lows once again. And what we can see is anyone who sees this move will get excited. It's an impulsive move to the upside. It's clear as day. We can see that price has moved up, we've broken structure, and we've even created imbalance. And a lot of people would be looking to stack buy orders in this particular area, which is great. And if we look at that and we just keep playing price forward just a little bit more, what are we likely going to see? We're going to see price break those equal lows. And what else do we see for the move? You can see that we create equal highs. We start to basically consolidate here. So any retail traders, once again, will see this as a potential move to sell, which you get into those beautiful situations where I totally sold here. I would have been up a ton of pips. I would have turned my $100 account into a $500 account, but that darn broker, he stopped me out. He hunted my order. No, he or they targeted the buy side liquidity, stop losses being rested above highs on double tops and double bottoms. And we can see the same thing happens here on these equal lows. Once again, we break the equal lows and we purge down, taking all of the sell side liquidity that was resting on here. If you see an obvious move in the market that even a beginner trader can see and understand, you better believe that the institutions are also targeting those bits of price action to do the opposite of what most people are thinking. This game is so heavily manipulated that we need to put on our hats and almost flip the script on what we've known in the past. That's the only way we're going to be able to begin to understand things. And then if we just look at this bit of price action, what we can see.
I just want you to know that I also share trading signals to community for free in the Telegram channel. For example, yesterday, I share the gold signals to community. You see all 3TP getting profit yesterday, and the whole community getting profit by this trade. You can see every day I share trading signals to community and most of them get profit. And especially, I do not only share the trading signals, but I also share the markup and the reason why I entered the trade. And by this one, everyone in the community can understand the reason, and by that, everybody can improve their trading skill. And to join community for free, you can click on the description of this video and click this link here, and you will be directed to the community and join for free.
We have an order block right here. If I move up to the hourly time frame, we can see we've broken structure. Very impulsive move, creates lots of imbalance. We have an hour order block. We go down to the 15-minute, we can refine it right down to this candle here. And what made this overall setup incredibly high probability? Well, I've already outlined that we have the 1 hour order block that created inefficiency, broke structure. And what we can see on the 15-minute is that we've broken several bits of price action, highs, and created a large impulsive move to the upside. We created equal lows, which creates our overall liquidity. We've also created some equal highs. So we've basically trapped traders in this particular range. We've come down impulsively in this case, which is also another interesting thing, because when you see this sort of framework where you get liquidity trapped, we have sell side liquidity and buy side liquidity that both get taken out on either end, and we see a large move to the downside. Anyone who sold right here and got stopped out is going to see this impulsive move and immediately get the fear of missing out and is going to want to try to get back in the trade. They might sell in this pullback that is a break and retest. Yeah, they might, if they're smart, take some profits here, which gives them a little bit of a win. But more often than not, they're going to swing for the fences because they took a loss here. They're going to be targeting much lower because we've seen this massive impulse move to the downside. We're going to start targeting lower. Well, that's not the way the market works. We're going to hunt their liquidity and we're going to continue back to the upside. We've tapped into an order block and we have moved up to the upside very rapidly, which just goes in line with the overall trend. But we can see the manipulation that takes place. We create the equal lows, we spike them, we have equal highs. Anyone selling here would get stopped out, create equal lows, equal highs, stop out, tap into an order block, and continue on the move. And this happens repeatedly. All we need to do is focus on equal highs, equal lows, and really just come down to the understanding of what they actually represent in the market, and understand that the conventional knowledge that we've known and loved in trading when we first started out is the reason why so many people fail to begin with. If the majority of traders learn to trade support and resistance, then why wouldn't institutions, algorithms, big money, smart money target those areas, knowing where people's stop loss is? There's no such thing as stop loss hunts because we're not smart enough to hide our stop losses in places that aren't logical based on conventional price action techniques. What we can see with this bit of price action as well, we've created equal lows. So if I just take that back to right there, you can see that prices come down very impulsively and then has just started to range overall. We've created equal highs. Doesn't really matter where you want to put them, because the concept of equal highs and equal lows, they don't have to be perfect. It's basically just looking for areas that would basically be building liquidity. You know, you see a clear top like that, that's a double top. People are going to sell with their stop loss just above here. So it's only natural that price is going to do that. Why? Because there's liquidity sitting above. You can get price action that looks like that. That's a relatively equal high, especially if this is a wick. because that's really just a liquidity range. You can get bits like this where you have equal highs here, you have equal highs here, and it works on all time frames as well. I'm just choosing to use the 15-minute just for this example. But what we can see is we had the equal lows. It looked like price was decelerating, slowing down, descending channel, whatever you want to call it. And what do? We spike down, we stop them out. More specifically though, what else do we see? An order block. And what makes this order block significant? It's broken structure, it's broken impulsively, it's continued. Look at this large impulse, it's created lots of imbalance. We have equal lows that print before it. Price then spikes, basically targeting that sell side liquidity, taps into the order block. And what does it do? It continues moving to the upside. And if we just look at price action, what's happening right now? Equal lows, equal highs. And that's where we currently are in the market. So now it's up to us to understand, what is the next play? Are they going to target buy side liquidity first? Or are they going to target sell side liquidity? We don't know for sure, but using this framework, if we're in this long down here, we're not going to want to manage our trades just below these lows. Why? Because then we're just going to be targeting all of the sell side liquidity that sits right here to make this move continue down. Whereas if we start to impulse up, we break structure, we've cleared out any buy side liquidity that rests up here. We could then break down, clear out all the sell side liquidity that sits down here, and then continue the move. And it's all a matter of looking at price in a slightly different context, understanding where is liquidity resting. That's the biggest question that I want you to begin asking yourselves, and it's something that we're going to dig deep into a lot more. The reason we've structured the course in the way that we have is to get your minds thinking about market structure, to get your minds thinking about order blocks. And now let's take it a little bit further and start really dissecting price action in the way of manipulation and liquidity, and understanding what smart money, institutions, algorithms, whatever you want to call them, are actually doing in these markets. Because once you start to begin to understand those sort of concepts, your trading is going to change dramatically. So if we take the lessons, if I'm just going to summarize what I'm saying here into, I'll just draw it with the brush tool. So ideally what we're looking for when we're framing up a trade, and we can plot this to looking for high probability order blocks, things like that. So say we see price is moving in an uptrend, and we've been able to identify a potential order block. Everything looks good. We've broken structure. We have bits of imbalance along the way as we move to the upside. We've broken this high, which has validated this order block. So based on everything that we know, we would be looking for price to come back down, tap in, and move to the upside. But let's take that one step further. We already know that we have a higher probability order block. It would be even higher probability if, say this is the 1 hour, that this was also resting within a 4-hour order block, the daily's bullish, all of these little things. But when we're looking at price coming back down to the order block, if we start to see things like this, where we basically get this sort of consolidation, we get equal lows and equal highs, we just wait, and ideally we could see a tap down in and then a break to the upside. This is what we would call a very high probability order block setup. And why? Because we have all of the criteria that we've met when looking through the order block content. We have a break of structure. We have a rapid move in price that breaks that structure, that creates imbalance. Of course, in this example, you don't see it creating imbalance, so we'll just have to imagine it with my amazingly drawn line here. But what we can see is then price moves back down, it consolidates, creating equal lows and equal highs. So we're trapping traders on either side, people who are thinking that this is a sell, and people who are on the overall buy idea, because we can see that the trend is up. When they are buying, they would be placing their stop losses more than likely within this point here. And what we do is we break down and tap into the sell side liquidity, which also happens to tap into our order block, which makes it incredibly high probability, because not only do we have an order block, but we have additional liquidity being generated from the sell side liquidity. So I hope this has been a useful example on understanding the manipulation and liquidity concepts that rest within the markets. and providing a larger framework to look at when you're looking for high probability order blocks and how to best approach them. Now, what I urge you to do is to jump on the charts and start looking at equal highs, equal lows, and apply your knowledge that you've learned about double tops, double bottoms, support and resistance. But think of it in this context of, okay, I see this. This is obvious. Where are people's stop losses going to be? And you'll notice that price always will tap into those areas of where stops are placed. Why? Because liquidity rests there, and the only thing that moves the market is liquidity. So when an institution is looking to place orders in the markets, they're likely placing thousands, tens of thousands of lots of orders. We can't hide that on the charts, but in order for them to actually be able to place those orders, they need, so say it's a buy in this case, they need to find tens of thousands of sell orders in order to facilitate their order, because for every buy order that's in the market, a sell needs to take it. It's an auction market. There needs to be that equilibrium where we have equal buyers and sellers in that case to facilitate orders, which is why we see price rapidly move away once large orders are placed, because there's no liquidity that rests at that area. You might have a ton of buyers, but you don't have any sellers, for instance. So when you see that, that is ultimately why the charts move. Everything is based on liquidity, and if liquidity doesn't exist in a particular area, they're going to manipulate and manufacture liquidity in order to fund these moves that push price in the intended direction.
I just want you to know that I also share trading signals to community for free in the Telegram channel. For example, yesterday, I share the gold signals to community. You see all 3TP getting profit yesterday, and the whole community getting profit by this trade. You can see every day I share trading signals to community, and most of them get profit. And especially, I do not only share the trading signals, but I also share the markup and the reason why I entered the trade. And by this one, everyone in the community can understand the reason, and by that, everybody can improve their trading skill. And to join community for free, you can click on the description of this video and click this link here, and you will be directed to the community and join for free.